Good morning, everyone, and welcome to today's presentation on 1031 Exchange Basics. My name is Jeff Stechmann. I'm the Eastern Regional Manager with Asset Exchange Company. Before we kind of dive in, I just want to kind of let everybody know how we're going to handle today's presentation. Don't feel like you have to write every single thing down because today's presentation is actually being recorded. And you'll receive a link to today's recording if you want to refer back to any of the topics that we're going to cover today. And in some of the topics that we're going to cover, I actually have in just like, single page PDF form. I'm going to email those out to everyone on the line today because, I've had a lot of times, if you're a realtor and you have a client that has a 1031 exchange need, you really would love to be able to email them something, and the email that I send out to everyone, it'll be in a format that you can easily forward on to a client. What some people even do is they'll include me on the email, introducing me to their client, and that way I can follow up with any questions they may have. If that works for you, with that works for me. All right. And then kind of give y'all some information about my background. I've actually been in the business. I'm entering my 28th year. I did a lot on the closing side of the business to get my start. I'm originally from New Orleans, so if y'all hear the accent come through, please forgive me. Every now and then it rears its ugly head. But I'm actually I live in the Tampa Bay area of Florida. And I've lived in Florida for 25 out of those 28 years. And, as long as I've been doing this, I've seen the really good times in the real estate industry. And boy, I've seen the really bad times too. So, hopefully we never have to go through those bad times again. Right now it has slowed up in the past few months. But I tell you, 2022, it was really a good year overall. So, we'll see what 2023 has to bring to all of us. But let me give you a little bit information about the company. Now, again, we're Asset Exchange Company, and we've actually been in business since 2006. And over the course of our existence, we've done about 40,000 1031 exchanges. It's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the industry, we're known as a qualified intermediary, QI for short. Now, depending on the area of the country that you live in, you may hear people refer to as an accommodator. Another common term is a facilitator, or just simply an intermediary. But again, most often people just call us QI. Now, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. Now we hold the proceeds from that sale on behalf of the seller, the exchanger, all right? Because the rule is they can never actually have receipt of those funds. If they ever do, they would lose their ability to do a 1031 exchange. And we're going to talk about that in greater detail in some upcoming slides. But just a word of caution about QIs. It's amazing in today's heavily regulated real estate industry that, at least on a federal level, there actually is no federal agency that oversees what we do. So what exactly does that mean for everybody out there, right? Well, what that means is anybody can be a QI, right? There's no type of requirements you have to have any type of E&O insurance. There's no type of requirements that you have to have any type of bond. There's no guidelines on where you hold the proceeds or the type of fund you hold the proceeds in. It's a really scary, scary thought when you sit down and think about it. So, if anybody on the line today is currently involved with a 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company, all right? Now, the great news when you deal with us, right? We're actually based out of California. Our home office is in San Francisco. And because we're California-based, well, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. Right? They do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. There's guidelines on the financial institutions where we hold the proceeds. There's guidelines on the type of funds we hold the proceeds in. We're subject to audit by that franchise tax board, which is great for anybody that deals with us in California, right? But any file that we work on, any exchange that we work on in any part of the country, that franchise tax board has oversight in anything that we do, right? Because as I mentioned, they could come into our office at a moment's notice and audit any file that we work on. So you do have some assurances when you deal with us. And then as far as our ownership goes, we're owned by two gentlemen. Now, they've been in the 1031 exchange business specifically for like 20 plus years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård. And Adam is considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The whole reason I like to bring his name up is because one of the things that we offer that honestly I don't know any other QI in the business offers is any of the exchanges that we're involved with, if for some reason they were to get audited by the IRS, we would actually provide free audit support. Right? We'd work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney owner, Adam Skarsgård. So another great reason to deal with us, right? Now let's talk a little bit about the history of exchanging. So believe it or not, exchanging has been around for close to 100 years. It really started back in the 20s with farmers, and back in those days, exchanging was pretty simple. Maybe I had a farm that I grew corn, and I knew another farmer that he had a farm that he grew wheat. Well, I wanted his farm, and he wanted my farm. So all we did is just swap farms, and it was really that simple back in those days. But our modern day exchanges, kind of the format that we follow today, that was really started back in 1979. And there was a gentleman by the name of T.J. Starker. Now, Mr. Starker, he lived in California, and he owned all this land in California with timber on it. Right? And what Mr. Starker did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is, in exchange for the land, they gave him what was referred to as exchange credits. And what Mr. Starker did with those exchange credits is, over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started back in 1979 with T.J. Starker. All right, so if anybody on the line has ever heard of the term a Starker exchange, that's where it comes from. It comes from T.J. Starker's last name. I talked to some CPAs that have been in the business, 40, 50 years, whatever it may be, and they still refer to a 1031 exchange as a Starker exchange. So again, if you ever hear that term pop up, that's where it comes from. It comes from T.J. Starker's last name. All right, now, so when we talk about 1031 tax deferred exchange, that name is actually derived from Internal Revenue Code Section 1031. All right, and the code states this: no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. Now, I know that's kind of a mouthful, right? Well, the code states that property held for productive use in a trade or business. So you can do a 1031 exchange on any type of real property that you use in your trade or business. All right, I'll give you guys an example of maybe the way that could work. We did an exchange for a gentleman. Now, he owned a daycare center, right? So he was using that real property for his business, right? So what he did is he sold it in a 1031 exchange. And in his case, the replacement property that he purchased, well, he went out and purchased another daycare center. Because why? Because he was going to use that real property for his business, right? So any type of real property that you use in your trade or business, you can sell that in a 1031 exchange, and you can buy as a replacement any other type of real property that you use in your trade or business, right? Now, The next part of the code where it says for investment. So for investment, that could be something as simple as, let's say you own a single family residential home and you hold it for investment. Well, how do you hold it for investment? Well, it's a rental property, right? You can take that rental property, you can sell that in a 1031 exchange, and then what can you buy as your replacement? Well, that's the next part of the code, light con property. All right, so what exactly is light con property? Well, light con property is any type of real property that either you use in your trade or business or that you hold for investment. You can sell that in a 1031 exchange, and you can buy as a replacement property any type of light con property, which is either property that you use in your trade or business or that you hold for investment. All right. So just because you're selling that single family residential home that you hold for investment, that rental property, right? When you sell that in a 1031 exchange, you don't have to buy another rental property if you don't want to. I mean, you can by all means if you do want to, but you could even buy as a replacement property a townhome, a condo, a duplex, a fourplex, vacant land, right? If you wanted to go out and buy a commercial piece of property, you can do that. It doesn't matter if it's residential or commercial. Everything is interchangeable with 1031 exchange. It doesn't even matter if you're selling property that you use in your trade or business. You could sell that and you could buy replacement investment property. All of that is interchangeable as well, okay? And you're not even limited geographically where you can buy and sell property. You can buy and sell real property anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands, right? If anybody on the line has ever heard of the term a like kind exchange, well, that's where it comes from. It comes from that part of the code that talks about like kind property. Now, I mentioned to you guys in the very beginning, I'm located here in the Tampa Bay area of Florida. Now, in Florida, the standard real estate contract that all realtors use here in the state of Florida is referred to as the FAR bar contract. Now, in that FAR bar contract, there's actually standard 1031 exchange language already built into it, all right? It's in section 18 and it's item N. Now, in the FAR bar contract, they actually refer to a 1031 exchange as a like kind exchange. So again, if you ever hear that term pop up, that's where it comes from. It comes from that part of the code that talks about like kind property. All right. Now, what are current tax rates? Well, when you sell real property, all right, if you have any gain in the property, you're going to be subject to capital gains tax. Now, capital gains tax right now, it's going to be either 15 or 20%. It just depends on your individual tax filing status. Right now, typically or historically, the 15% was applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year, right? That's where you were at the 15% capital gains tax rate. Now, the 20% capital gains tax rate, historically, that was applied if you were single and you had income of greater than $400,000 a year, or married and you had income of greater than $450,000 a year, right? That's where you're at the 20% capital gains tax rate. Now, the reason I say historic, right, is the income levels have risen just a bit when they passed the last tax reform bill a few years ago. But, you know, any way you look at it, you're still going to be subject to either 15 or 20% capital gains tax rate. Now, on top of that, you'd also be subject to an additional tax. It's referred to as depreciation recapture tax. Now, that's an additional 25% tax. Now, you might be asking yourself, what is that all about? How does that work? Well, depreciation recapture tax works like this. Any depreciation that you've claimed for the lifetime that you've owned that property, when you go to sell it, they're going to hit you with a 25% depreciation recapture tax on the entire amount of depreciation that you've claimed for the lifetime that you've owned the property. All right. Now, you may also be subject to an additional tax. It's referred to as the Medicare tax. Now, that's an additional 3.8% tax. What is that all about, right? Well, the Medicare tax, that was passed back in 2010 with the Affordable Care Act, you know, Obamacare, right? It actually went into effect in 2013. Now, it was one of the things that they passed to try to offset some of the cost of the Affordable Care Act. Now, the great news is when you do a 1031 exchange, you can defer having to pay any of these taxes. Now, what am I not listing up on the slide? Well, I'm not listing anything to do with state taxes, right? So for those of y'all that are located in a state like me, like Florida, well, we don't have state income taxes, so we don't even need to worry about that, all right? But if you live in a state or you're selling property that's located in a state that has state taxes, you would also be subject to whatever those state taxes are. Now, the great news is when you do a 1031 exchange, you can also avoid having to pay those state taxes. Now, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state taxes. I'll give you guys a couple of examples, at least on exchanges that I was personally involved with. All right, so we did an exchange for a gentleman. Now, he was a Florida resident, okay, but he had a property, an investment property, located in California. Now, California has state taxes. And I want to say their state taxes can be as high as like, I want to say it's like 11 or 12%. It's kind of like the more you make, the more they tax you. Well, even though he wasn't a California resident, he was a Florida resident, but he was selling property located in California. Guess what? California was still looking for their state taxes. Now, the good news for him, again, was he was doing a 1031 exchange. So he was going to be able to get out of having to pay those state of California taxes. Now, the way he got out of them is he had to complete the state of California form, submit it to the state. That's how he got out of it. But now it's my understanding he's got to submit that form every year thereafter. The year he doesn't submit the form, they come after him for the taxes. All right. Now, we did another exchange for a lady. She was another Florida resident, but she was selling property. I want to say it was in Maryland. All right. Now, good news for her was she was doing a 1031 exchange, and she was going to be able to get out of having to pay those state of Maryland taxes. Right. Now, what they made her do was she had to complete this form, state of Maryland form. I think we even had to sign off on it. And I want to say she had to submit it to the state like 20 days prior to closing. That's how she got out of having to pay the state of Maryland taxes. So again, every state kind of has their own way of completing some type of form or going through some type of process in order to get out of having to pay those state taxes. All right. Those of y'all that are realtors on the line today, just think about it just for a minute. If that's your client and they're sitting there thinking they're going to have to cut a check for whatever the federal taxes are, what we have on the slide, right? But also remember, if they live in a state or selling a property located in a state that has state taxes, and they're going to have to cut that additional check, right? They're not talking about 1031 exchange. Boy, that's a perfect opportunity for you to bring it up, right? Because you could talk to me and say, look, avoid having to cut that check or those checks, right? Do a 1031 exchange. Now let's go out and find you something even better, because just think about it. If no longer do they have to cut that check or those checks for the taxes, it's just going to give them that much more buying power to go out there and buy a better property, right? And if they can buy a better property, hey, hopefully it's going to be a higher dollar property for them and also equate to a higher income producing property for them as well. And what does that do for you as a realtor? Well, you look great to the client, right? By recommending a 1031 exchange. And now if they can go out and buy a higher dollar property, well, hopefully you just increase your commission, all by recommending a 1031 exchange. All right. So again, hopefully some things to think about for everybody on the line today, right? Now, I get this question probably about every day. All right. People will ask me, they say, well, Jeff, how long do I need to own a property for it to be considered an investment property? And the honest answer is, I really don't know, right? Because there's nowhere in the code that states how long you need to own a property for it to be considered an investment property, right? The code just states that you need to use that real property in your trade or business to hold it for investment. Now, if you ask some CPAs, they'll tell you, hey, a good rule of thumb is to really hold on to the property for at least a year. And if you just think about the logic behind that, right? Let's say you buy and sell your property this year, all right? So you got your, you have your property, you buy it this year. It's 2023, right? Now, you're going to claim that property on your 2023 taxes, right? Any income that's coming in from rent. any expenses that are going out, you're going to report that on your 2023 taxes. That's going to be showing reporting it as an investment property. Remember, you're holding it for a year, right? For 12 months. You're also going to report it on your 2024 taxes as an investment property. All right. So over 2 tax filing years, you would actually be showing to the IRS via 2 different tax returns that property is an investment property. All right. Is that a good rule of thumb? Well, the answer is maybe. Okay. Now you ask some other CPAs, they'll tell you no. You really need to hold on to it for at least 2 years or 24 months. Now, one of the reasonings behind that is back in 2008, the IRS came out with guidelines regarding vacation homes. Right now, in the guidelines for vacation homes, the IRS stated for a vacation home to be considered an investment property, you must own that property for a minimum of 2 years or 24 months. Right. So some CPAs pick up on that and they say, well, for vacation homes, the IRS is actually giving us guidelines stating for a vacation home to be considered an investment property, you must own it for at least 2 years or 24 months. And then they're of the opinion that, okay, for any type of investment property, a good rule of thumb is to hold on to it for at least 2 years or 24 months, all right? But the reality of the whole thing is, it's not so much about how long you own the property. It's more so about your intent. Now, your intent could be something like this. Hey, did you advertise the property for rent? Did you advertise it for fair market value rent? Now, if fair market value rent is, let's just say, $1,500 a month, and you're advertising it for $5,000 a month, yeah, you know what? The IRS is probably going to have an issue with that. All right, if you get audited and the IRS comes in and says, okay, prove to us that property is an investment property, you're going to have to be able to back it up. All right, now I'll list one particular court case on the slide. It's referred to as Resnick versus the commissioner. Now, in that particular court case, the circumstances was you had a husband and wife, right? They owned a single family residential home. That was their primary home. Now, they also owned another single family residential home that was an investment property, all right, a rental property, right? Now, what they did was they sold the investment property in a 1031 exchange. And the replacement property that they purchased, well, in their case, they purchased another single-family residential home. That was going to be the new investment property, right? Now, during the 6-month period after they did that 1031 exchange, they actually ran a classified ad in the town newspaper that they lived in, advertising the property for rent at fair market value, okay? They even showed it to 2 potential renters during that 6-month period, but for whatever reason, they could never get the property rented out. Now, what else happened during that 6-month period was one of them loses their job, all right? So they had a mortgage on their primary home. They also had a mortgage on that investment property, but what? It wasn't rented out, right? So after 8 months of ownership, they sold their primary home, and they moved into the investment property. Now, in that particular court case, it was ruled that their intent for that investment property was to hold it as an investment. But what happened? Well, the circumstances changed, right? And they were forced to do something. So it's not always going to be how long you own the property. It's more so going to be about your intent. And as I mentioned, if you ever get audited, you're going to have to be able to back it up. Okay? So everybody remember that, hopefully, investment intent. All right, now, vacation homes. Hey, I always like to talk about vacation homes, especially because I live in Florida, right? And here in Florida, it seems like everybody either has a vacation home or everybody wants a vacation home, right? So how does that vacation home qualify as an investment property? Well, this is actually referred to as Revenue Procedure 2008-16, right? And the first guideline I've already given you guys, you must own it for at least 2 years or 24 months, right? Now, for every 12-month period of ownership, you must rent that property out for a minimum of 14 days at fair market value. Now, you can use it for some personal use, okay? For every 12-month period of ownership, you can actually use the property for 14 days personal use or 10% of the total time that you had it rented during that 12-month period. So here's a quick example, maybe of the way that could work. Let's just say during that 12-month period, you actually rented the property out for 200 days, right? So 10% of 200 would be what? Would be 20. So you could use the property for 20 days personal use instead of the 14. All right. If that property meets those guidelines, it qualifies as an investment property and you can use it in a 1031 exchange. Now, if it doesn't meet those guidelines, I wouldn't necessarily say it would be disqualified. In that particular case, I'd recommend to the client, I'd say, look, talk to your CPA. And if you and your CPA can come to an agreement where you feel like you can justify that property as being an investment property, then hey, use it in a 1031 exchange. Right? We're always going to recommend to clients, talk to your CPA because why? Because your CPA is going to have way more information than I ever would, that I would even care to ever know, right? If the CPA comes back and says, yeah, I feel like we could justify that property as being an investment property, and use it in a 1031 exchange, all right? Remember I told y'all before we kind of dove in today, some of the topics that we're going to cover, I have in just like PDF form. This is one of them, all right? So remember, I'm going to send out an email. I'll include this PDF that talks about vacation homes. So, be on the lookout for it, okay? Now, what type of property is excluded from 1031 exchange? Well, your primary residence, okay? You cannot do a 1031 exchange on your primary home, your primary residence, all right? The good news for your primary home, which you may qualify for, is what they refer to as a Section 121. All right, now the guidelines to qualify for the 121 are you had to have lived in that property as your primary residence any 2 out of the last 5 years, right? And if you do qualify, when you sell your primary residence, if you have any gain and you're single, the first $250,000 of any gain is tax exempt, and if you're married, the first $500,000 of any gain is tax exempt. Now, you don't need anybody like me to help you with the 121. That's just something that you claim on your tax return in the year that you sell your primary residence, right? But primary residences, primary homes are excluded from 1031 exchange. Property held for sale is also excluded from 1031 exchange. I'll give you guys a quick example of maybe the way that could work. Here in Florida, we have a lot of these like national home builders, like Pulte Homes, Lennar Homes, KB Homes. Let's say I'm Pulte Homes. Now, excuse me, Pulte Homes, they're one of the largest single-family residential home builders in the entire country. They're a publicly traded company. They build newly constructed properties in multiple states, all throughout the United States. Now, the properties that they build, when those properties are completed, well, what do they do with them? Well, they turn around and sell them, right? Because they're holding those properties for sale and not for investment, they cannot do 1031 exchanges on those types of properties, all right? So property held for sale is excluded from 1031 exchange. Now, dealer property is also excluded from 1031 exchange. Now, what exactly is dealer property? Well, dealer property might be somebody that we most often refer to as a flipper. They buy a property, 2 or 3 months goes by, during that 2 or 3 month period, they fix the property up, right? And when it's completed, what do they do with it? Well, they turn around and sell it as well, right? You can't do 1031 exchanges on those types of properties because that's like that's the business that they're in. That's like their inventory. They buy properties, they fix them up, and they turn around and sell them. Well, you can't do 1031 exchanges on those types of properties. All right, now, here's a possible solution for a flipper. Again, let's say they buy a property, right? 2 or 3 months goes by, they fix it up. And when it's completed, instead of turning around and selling it, they go to their realtor and they say, hey, can you put this in the MLS system showing it for rent? Now, let's make sure we put it in there for fair market value rent as well, right? Well, that's a little bit different because why? Because now all of a sudden, what are they doing? They're showing that their intent is to hold the property for investment and not for sale. Hey, who knows? Maybe they even show it to a potential renter. They run some type of credit check on that potential renter. I don't know. They don't have such great credit. They decide not even to rent it to that potential renter. If that flipper ever gets audited and the IRS comes in and says, okay, prove to us you held that property for investment and not for sale, they're going to have to be able to back it up. All right, and the example I just gave you guys is a good shot they could, right? They could say, look, here's an email that I sent to my realtor on such and such a day requesting that that they put it in the MLS system for fair market value rent. Here's the MLS listing showing it for fair market value rent. Here's the day I showed it to that potential renter. Here's the credit check I ran on that potential renter. All of that type of stuff is going to be what? It's going to be their backup, right? Their proof that their intent was to hold the property for investment and not for sale, right? But remember, everybody, if they buy a property and however long it takes for them to fix it up, when it's completed, if they turn around and sell it, you can't do a 1031 exchange on those types of property, right? Now, foreign property is also excluded from 1031 exchange. Now, this might be pretty obvious to most people on the line, but let's say, I couldn't sell an investment property located here in Florida, right? Sell it in a 1031 exchange, but then try to go out and buy replacement property, I don't know, somewhere in Canada or Mexico or somewhere in Europe. It has to be what? Property located anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands, right? So foreign property is also excluded from 1031 exchange, all right? Now, what are the tax deferral requirements? How do you get a full deferral? Well, if you want to defer your taxes 100%, okay, when you do a 1031 exchange, rule number one is you must reinvest all of the net proceeds in property of equal or greater value. Now, what exactly is the net proceeds, right? The net proceeds, that's the cash, right? That's the cash that normally you would get out of that closing when you sell your property, right? Now, we're the qualified intermediary, okay? We're going to hold those proceeds from that sale on behalf of the seller, the exchanger, okay? Because the rule is they can never actually have receipt of those funds. If they ever do, they would lose their ability to do a 1031 exchange, right? So they can't close today, call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late, right? They couldn't even close today. Walk out of the office of the escrow company, title company, attorney's office, whoever just did the closing, go to the parking lot, get in their car and call me from the car and say, hey, Jeff, I want to do a 1031 exchange, right? Because at that point, they have what's referred to as constructive receipt. Okay, their funds might be sitting in that escrow account of the escrow company, title company, attorney. Whoever just did the closing, they might be waiting to wire the funds out to them, right? Again, at that point, they have what's referred to as constructive receipt. They have a legal right to the funds. They've lost their ability to do a 1031 exchange, right? So we have to get involved prior to the closing, basically prior to them walking out the door, all right? Now back to the rule, all right? So we're gonna hold those proceeds from that sale on behalf of the seller, the exchanger. Now, what do they need to do with them? Well, rule number one is they have to take that entire amount, all right, the net proceeds, and they have to use the net proceeds to go out and buy a replacement property, or it can even be multiple properties if they want, where the purchase price or the combined purchase prices, if they do buy multiple properties, is at least equal to, or it can even be greater than, whatever the sales price was on the property that they sold, their relinquished property, all right? That's rule number one. Now, rule number two is if they have debt, if they have a mortgage they're paying off, okay, you actually are required to obtain an equal amount or greater debt in the purchase of any replacement property or properties. Okay, now that rule can actually have an exception. Okay, if you have cash that you're willing to use towards buying your replacement property, you can offset that rule. Okay, now obviously, if you have no debt, if you don't have a loan that you're paying off, well, you're not required to obtain a loan in the purchase of your replacement property or properties, but you do have the option, if you need to, or if you want to help you purchase your replacement property. Okay. Now, there's actually some timelines associated with 1031 exchange that I want everybody to be aware of. Okay. So from when you close, from the closing date, okay, from that point forward, you're going to have 180 calendar days to purchase any replacement property or properties. Now that's calendar days, right? It's holidays, it's weekends. Hey, I live in Florida. okay? From June 1st to November 30th is what? It's hurricane season, okay? If we're getting hit with a hurricane and everything shuts down for a day or two or a week, whatever it may be, none of that matters with 1031 exchange, okay? That clock is always, always, always going to be ticking, all right? So keep that in mind. Now, the first 45 days of the 180 days is what they refer to as the identification period. Now, what that means is you must identify any potential property or properties you want to buy. Now, they don't even need to be under contract. You just have to identify any potential property you want to buy. And that's something else that we're going to assist with, all right? We're going to provide to the client a form. Now, we refer to it as the identification ID letter. But basically, it's going to have some blank lines on it. It's going to have to be specific to a property address or addresses, okay? Client's going to have to fill that out, sign it, get it back to us by midnight of the 45th day, right? That's how they will formally identify their replacement property directly to us, the qualified intermediary. All right, here's the thing about the 45 days. Let's say they happen to find the perfect property, but it's day 46. Okay, at that point, it's too late for them. All right, so whatever you put on that form by midnight of the 45th day, you're going to have to make sure you're going to be able to purchase at least one of those properties. And when do you have to purchase it by? Well, you got to purchase it by day 180. All right, if you're buying that property on day 181, unfortunately, you blew your exchange. You're going to be paying all your taxes. All right, there is no exceptions to the timelines. There is no exceptions to the property that you identify, okay? Let's say you identify 3 properties, all right? You put that on the form, sign it, get it back to us by midnight of the 45th day. Now, after midnight of the 45th day, one of those properties sells, right? There is no going back and saying, hey, one of those properties I identified, it just sold. There's no way I could ever buy the property. Now, it does not matter, right? You would only have the opportunity to purchase those 2 other properties that you would have identified. All right. So again, just keep that in mind. It's very set in stone. All right. For 45 days to identify, a total of 180 days to purchase your replacement property. No exceptions. All right. Now, there's actually some identification rules that I want everybody to be aware of. Okay. That's actually three different rules. Okay. And I'm going to read each one of the rules to you. And if you don't quite understand them when I read them to you, don't worry about it, because I'm going to walk you through examples of how the numbers work. And hopefully once I explain to you how the numbers work, it'll make more sense to you. All right. So the most popular rule that we see investors enact is referred to as the 3 property rule. Now, the 3 property rule states that you can identify up to 3 properties without regard to the fair market value of those 3 properties. So what exactly does that mean? Fair market value, right? Well, if you identify 3 properties or less, okay, the purchase prices of any of those properties can be any dollar amount. It does not matter as long as it's 3 properties or less. Okay, now, if you want to identify more than 3 properties, you can do that with 1031 exchange, but it's going to put you into this next rule. It's referred to is the 200% rule. Now, the 200% rule states that you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean, right? Well, let's just say you go out and you identify 5 properties, right? Because you identified 5 properties, what would have happened? You would have exceeded your 3 property rule. That would put you into the 200% rule. So what that would mean is the combined purchase prices of all 5 of those properties could not exceed 200% or 2 times whatever the sales price was on the property that you sold, the relinquished property. All right. Now, if you want to exceed the 3 property rule and you also want to exceed the 200% rule, well, you can do that as well, but it's going to put you into this next rule. All right. It's referred to as the 95% rule. Now, it's very rare that we see investors even enacting this rule. Honestly, it doesn't really make a lot of sense in the way that it's written, okay? But remember, everybody, this is the IRS, and sometimes this stuff just doesn't make sense, right? Because it reads like this. You can identify over 3 properties. you can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. Now, I know that's probably about as clear as mud, right? Let me show you other examples, especially with the 95% rule, and hopefully it'll make sense to you, okay? So here's the three property rule. Again, if you identify three properties or less, the purchase prices of any of those properties can be any dollar amount. All right, so here's an example. All right, so we sell our property, we sell our relinquished property for $1 million. Now, we go out and we identify three properties, all right, because we've identified three. We're in the three property rule. Now, let's keep the math simple. Let's say we're going to be buying each one of those properties for $1 million each. So how much have we identified in property? $3 million worth of property, right? Now, because again, we're in the three property rule, we could be buying each one of those properties for any dollar amount. We could be buying each one of them for, let's just say, $10 million each for a total of $30 million in identification. Again, it doesn't matter as long as it's three properties or less. But what does matter? Well, I'll say it again. If you identify three properties, boy, you better make sure you're going to be able to purchase at least one of those properties. So, you know, what's the best way to lock up a property? Well, it's to put one of them under contract, right? Now, you're not required, as far as the rules go, that any of them have to be under contract. But in practice, what we typically see is an investor will put one of those properties under contract. That's one of the properties they identify. And then, you know, maybe they'll identify two other properties just as backup, because what could potentially happen is after midnight of the 45th day, if the property that they do have under contract, if that whole deal falls apart, well, at least they'd have the opportunity to purchase those two other properties that they would have identified. All right, so hopefully everybody gets this one. Now, here's the 200% rule. All right, this is where you exceed the three property rule, but you cannot exceed 200% or two times the combined fair market value of the property being sold. All right, so here's how it works. Again, we sell for $1 million. Now, in this example, we go out and we identify five properties, right? Because we've identified five properties, what happened? We exceeded our three property rule, right? So that's going to put us into the 200% rule. So what does that mean? What that means is the combined purchase prices of all five of those properties cannot exceed $2 million. Now, you might be asking yourself, where is he getting that $2 million from? All right, well, we sold for $1 million, right? So 200% of that $1 million sales price, or two times that $1 million sales price, is how much? $2 million, right? So that's where I'm getting it from. I think this one is pretty straightforward. Hopefully everybody gets it. All right, now, here's the 95% rule. Again, this is where you exceed the three property rule. You exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified, all right? So here's how it works. Again, we sell for $1 million. Now, in this example, we actually go out and we identify 10 properties, all right? Because we've identified 10, what just happened there? We exceeded our three property rule. Now let's keep the math really simple with this one too. Let's say we're going to buy each one of those properties for $1 million each, all right? So how much have we identified in property? $10 million worth of property, right? Because we've identified $10 million worth of property, what just happened there? We exceeded our 200% rule, right? Because that was how much? $2 million. So that's going to put us into the 95% rule. So let's just say in our example, we're only able to purchase 9 out of the 10 properties that we identified. Well, that's only going to be 90%, or $9 million. That's not going to be 95%. If we do that, if we only are able to purchase 9 out of the 10 properties, guess what's going to happen? We're going to blow our entire exchange, and we're going to be having to pay all of the taxes. All right. So the reality of the way the 95% rule works in practice is really 100% of whatever you identify, you're going to have to buy, all right? And we're using really simple numbers, right? We're saying, hey, each one of them is going to be an even $1 million. You know, those purchase prices, they're going to be all over the map, right? It's going to be really hard to sit down and say, okay, let's see. If I buy this property, oh, wait, that's only going to put me at 93%. All right, maybe I need to make sure I purchase this other property. Oh, wait, that's only going to put me at 94%. Again, in practice, the way the 95% rule works is 100% of whatever you identify, you're going to have to buy. All right. The IRS wants to limit you in how many properties you can identify. They don't want you going out there identifying everything under the sun, because you know what's going to happen if you identify everything under the sun? You're going to have to buy everything under the sun because of this crazy 95% rule. Again, we don't see it enacted that often, but just remember it does exist and it is out there. Okay. Now, how does the whole closing process work when it comes to 1031 exchange? Well, we don't really get the process started until there's a contract on the property that's being sold, right? Because the way the process starts is I need to get a copy of that contract. I also need to get the contact information for whoever's going to be handling the closing. And obviously, I would need to get the client's contact information, because what happens at that point is we're going to reach out to whoever's doing the closing, right? And what we get from that company is a copy of the title search, the title commitment. It may also be called the title binder. It just depends on the different areas of the country that you live in. But basically, it's a search of the title, all right? Now, once we get that in hand, along with the contract, then what we're going to do on our end is we're going to prepare what we refer to as an exchange agreement, right? And that's going to be documents that will set up the 1031 exchange. We're going to send those over to whoever's handling the closing. And basically, they sit there waiting for the closing to happen. Now, day of closing, client's going to go in, seller, right? They're going to sign those documents. Now, again, when they sign those documents, that'll set up the 1031 exchange. But also when they sign those documents, that's going to give us the ability to step into their shoes as the seller, all right? That's also going to give whoever is handling the closing, escrow company, title company, attorney, all right? That's going to give them the ability to take the proceeds, the net proceeds from that sale, and they're going to wire those net proceeds over to us. We're going to hold them on their behalf, all right? That transaction takes place, and then what happens? The clock starts ticking, right? 180 days to close. The first 45 days of the 180 is the identification period. We're going to be sending out that identification ID letter. Client's going to fill it out, sign it, get it back to us by midnight of the 45th day. Now, once they get one of those properties under contract that they identified, we're going to need to get a copy of that contract as well. And just like on the sale, we needed the contact information for whoever's handling the closing. Same thing on their purchase. We're going to need to get the contact information for whoever's handling that closing, right? It's probably going to be a different company. Typically, it's not the same company. Because if you think about it, we're going to be holding all their funds from their sale, right? We're going to need to get a contact person. We're going to need to get that company's wiring instructions, okay? We're going to prepare some other documents that we'll send over to that company. They'll sit there waiting for the closing to happen. Day of closing, the client will go in, they'll sign those documents. When they sign those documents, that's going to give us the ability to step into their shoes as the buyer. That's also going to give us the ability to take the proceeds that we were holding from their sale, and we're going to wire those proceeds over to whoever's going to be handling the closing to help them purchase their replacement property. That's it. That's how the whole closing process works. It's not really that complicated of a process when it comes to the actual closing. Just everything leading up to it is the complicated stuff. You know, it's what you see day in and day out in the real estate world, all right? Deciding on what you want to buy, you know, that can be a little tricky, you know, identifying the property, but negotiating contracts, do you need to get financing, applying for a loan, all that type of stuff is the more complicated stuff when it comes to 1031 exchange, okay? Now, what do we actually charge for our services? Well, everything that we talked about today, the most common type of exchange is referred to as a delayed exchange. You'll hear other people refer to this type of exchange as a forward exchange, but it's where you sell first, you sell your relinquished property first, and then you buy last. You're buying your replacement property by day 180. You're buying that replacement property last. All right, again, that's the most common type of exchange that we do. 90 to 95% of all the exchanges we do are delayed. All right. What do we charge? We charge a flat $1,250, $1,250. We don't collect anything until the closing happens, right? We don't charge any type of setup fees. We don't charge any type of wiring fees, okay? I just walked y'all through the process. You know, we like to get the process started when a contract gets signed for the property being sold, right? We prepare that exchange agreement. We send it over to the escrow company, title company, attorney. They sit there waiting for the documents to be executed to the day of closing, right? If for some reason the closing never happens, the contract falls apart, the buyer walks, or the client, the seller, decides at the very last minute they've had second thoughts, they're not going to move forward with any type of 1031 exchange, we don't even charge any type of cancellation fees, right? Again, our fee is not incurred until the day of closing. And the good news is our fee actually covers the sale of one property and the purchase of up to 3 replacement properties. That's it. We don't have any other hidden costs, fees, anything associated, additional costs. As long as you're selling one, you can buy up to 3 replacement properties. Now, there's a few other type of exchanges. We don't have time to go into them today. All right. I do have another class coming up. It's Advanced 1031 Exchange Strategies. We talk about these other types of exchanges. There's one that's referred to as a reverse exchange. Okay. The reverse exchange works just the opposite of delayed. It actually gives you the ability to buy first, to buy your replacement property first and sell your relinquished property last. Okay. They can be significantly more complicated than a delayed exchange. Okay. We have to form a separate company. We go on title. We actually purchase the replacement property before you sell your relinquished property. Those start off at $8,500. Okay, again, significantly more complicated than a delayed exchange. There's another type of exchange referred to as a construction exchange. Another term you hear people refer to it is an improvement exchange or a built to suit exchange. What that does is, they kind of can work is you sell your relinquished property in a 1031 exchange, you find a replacement property, but you want to do some improvements to it before you acquire it, all right? So you can do this thing called a construction exchange, improvement, or built to suit exchange, all right? Those can be significantly more complicated than a delayed exchange, all right? We have to form a separate company. We go buy the replacement property, and then we oversee the construction improvements, all right? Those start off at $8,500. Remember I told you all in the very beginning, one of the owners of our company is a tax attorney, Adam Skarsgård. He personally handles any reverse exchanges or construction improvement or built to suit exchanges because they can be so complicated, okay? He looks at each one of them individually, looks at the complexity, and decides on what our fee is based off the complexity. But either one, or any of them start off at $8,500, all right? Again, we don't have time to go into all the details of the various types of exchanges. If you want to learn more about them, join me in my advanced class, okay? I do this class, the basics class. I have an advanced class that I teach as well. And then I also have a 2-hour class. It's called Discovering 1031 Exchange. For those of y'all that are Florida realtors, okay, it's approved for 2 hours of continuing education for your Florida real estate license. Anybody can attend it, but it's kind of a combination of today's class, the advanced class, and even some additional information, all right? If y'all registered, had the links to register for today's class, the links for the advanced class and also the Discovering 1031 Exchange, the 2-hour class was included. If not, let me know. I can get it out to you. Okay. All right. So we're done with the presentation. I'll open the floor up to questions right now. If you have any questions, there's a box that says questions. Go ahead and feel free to type your questions in. While we're waiting for the questions to come in, I'll mention this to everybody again. You know, today's presentation was recorded. Okay, you're going to receive a link to today's recording if you want to refer back to any of the topics that we talked about. And also some of the topics I mentioned here and there, the vacation home ones. Some of the topics we covered, I haven't just like single page PDF. I'm going to email those out to everybody. All right, some of the information I even have available in Spanish and also in Chinese. If you want those additional languages, please let me know and I'll get them out to you. As I mentioned, I have 3 different classes that I teach. I do these every single month, but I do a lot of individual classes for real estate offices, boards of realtors, title companies, attorneys, CPAs. If you think other people in your office would benefit from me doing a class for your individual office, please let me know. All right, I have information I can email over to you. if you're the manager, owner, president, or if you have to forward the information on to the powers that be, let me know. I'll get that information over to you. Okay. So let's see here. Doesn't look like there's any questions coming in, which is probably a good thing. And if you have a question that's a little bit more complicated than typing it into a box in 30 seconds, I totally get it. All right, you don't have to be an expert on 1031 exchange. I want to be a resource for everybody on the line today. All right, if you have clients that have 1031 exchange questions or needs, or you individually, if you're an investor yourself, I'd be glad to talk to you. I'd be glad to talk to your clients. Okay, please let me know. I talk to people all day long about 1031 exchange. I mentioned that email that I'm going to be sending out. I mentioned this in the beginning. If you want to forward that on to your client, include me in the email introducing me to your client. You can step back and I can follow up with any questions that they may have. If that works for you, it works for me. However you want to handle your clients is really fine with me. Okay. If y'all do have questions, again, we can always talk offline. You can shoot me an email directly if it's a little bit more complicated than just typing in a box today. All right. Well, we'll go ahead and wrap it up for today. I appreciate everybody for joining. Hopefully you learned a little something about 1031 exchange. And if you want to join in any of the future classes, please register for them. And you'll learn some additional information. We cover various topics. The advanced one, we cover some of the topics we covered today, but even some more advanced topics like the different various exchanges. We talk about entities and so on. So feel free to register. All right. Well, everybody have a great rest of your week, and please stay safe, stay healthy, everybody. And I appreciate you joining me today. Thank you. Have a great day. Bye-bye.